Welcome to Stock Knowledge and News with Arieous Invest, your trusted source for updates, earnings reports, and actionable insights to sharpen your stock market game. Join us as we explore market trends, decode the latest news, and empower your financial journey with expert stock knowledge. This is Trading Reimagined. Let's get started.
Hey everyone, welcome back to the Deep Dive. So many of you have been asking for this one, a deep dive into Trump's tariffs and what they might mean for your investments.
And for good reason. It's a pretty complex situation.
Oh, it is.
Yeah.
Especially after the president, dropped that bomb over the weekend. 25% tariffs on goods from Mexico and Canada.
And you saw how the markets reacted right away. $1 trillion pre-market loss.
Yeah, that's not something to just brush off $1 trillion.
Yeah.
That's definitely a red flag.
Yeah, investors are taking this very seriously. And they should. This is a big deal. These tariffs combined with, what's already going on with China, the 10% tariffs on Chinese goods. This has the potential to really upend the global economy.
Yeah, no doubt. So for this deep dive, we want to try to help you figure out what it all means for your personal investments, not just the market as a whole.
Right. Exactly. So let's start by breaking down how these tariffs actually work. Think of it like a chain reaction.
Yeah.
The U.S. imports a ton of stuff from both Mexico and Canada. And we're talking about things like 75% of our crude oil comes from Canada.
75%? Really? I knew it was a lot, but...
Yeah, it's huge. And here's the thing. A lot of people don't realize this, but the tariffs, they're not paid by Mexico or Canada. They're paid by the American companies that are importing the goods.
Oh, so those businesses are kind of caught between a rock and a hard place, right?
Yeah, pretty much. They have to choose. Do they eat the cost and watch their profits shrink? Or do they raise prices and risk losing customers?
All right. So either way, it's a potential hit.
Yeah. So how do you see this playing out for the average person?
Well, let's say you need to get your car fixed.
Right.
And the parts that they need to use for the repair, they come from Mexico. Now, that company that imports those parts, they're paying 25% more for them. So what do? They have to raise the price of those parts. And guess who ends up paying more?
Makes sense.
Yeah.
That's the ripple effect you were talking about, right? Exactly. And it's not just car parts. Think about coffee. A lot of coffee beans are imported. If those prices go up because of tariffs, your morning cup of coffee is going to cost more.
Yeah, okay, so that makes sense why the markets are so on edge right now.
Yeah.
But here's what I'm curious about.
Yeah.
Amidst all this chaos, the U.S. dollar is actually getting stronger. What's going on there?
Yeah. So that's because when things get shaky in the global economy, investors tend to see the U.S. dollar as a safe haven.
Oh, okay.
It's viewed as stable and reliable. So when they get nervous, they kind of flock to the dollar. They put their money into dollar-denominated assets, which drives up the demand and pushes the value of the dollar higher.
So the dollar has this kind of built-in protection even when things are a mess globally. Huh. So what makes something a safe haven asset anyway? How does the dollar fit into that?
Well, basically, a safe haven asset is something that's expected to hold its value or even go up in value when markets are uncertain or when investors are feeling risk averse. And the U.S. dollar has a few things going for it. The U.S. economy, it's still the biggest in the world, and it's seen as relatively stable. Plus, the U.S. dollar is the world's reserve currency, so it's used all over the place for international transactions.
Right.
Which means there's always a demand for dollars supporting its value. And then you've also got the U.S. bond market, which is super deep and liquid. So investors see it as a safe place to park their money when things get rough.
Okay, yeah, that makes sense. So if the dollar is getting stronger, that means other currencies like the peso and the Canadian dollar, they're probably getting weaker.
Right.
So if someone's holding those currencies or has investments tied to them, they could be losing money right now.
That's exactly right. And it really shows how interconnected all this is, even if you're not directly investing in international markets. These tariffs, they have a ripple effect globally.
Yeah.
It's all connected.
For sure. Okay, so we've got, tariffs potentially squeezing company profits, the dollar getting stronger, and maybe higher prices for consumers down the line. It's a lot.
Yeah, it is a lot to take in. But I think it's important for people to remember that this isn't like a market crash. This isn't going to happen overnight. These tariffs, it's more like a slow burn. They're going to reshape the economic landscape gradually over time.
I like that. A slow burn.
Yeah.
So instead of panicking, we need to be thinking strategically long term.
Right.
Right.
Exactly.
So how can investors adapt their portfolios to not just survive this, but maybe even come out ahead?
Well, that's the key question, isn't it? And it starts with understanding which sectors are going to benefit from these changes and which ones are going to be most vulnerable. So let's talk about the potential winners first. One area to consider is domestic-focused industries.
Oh, okay. So companies that mostly operate within the U.S.
Right, exactly. They're not as reliant on imports or exports, so they're kind of insulated from these global trade disruptions.
Got it. But are there any specific types of companies within those domestic industries that you think are particularly well positioned?
Oh, yeah, for sure. Utilities, for example. They provide essential services like electricity and water. Their operations are, largely confined to the U.S., so they're not as affected by, what's happening with global trade. Another area to look at is real estate, specifically companies that are focused on the domestic housing market.
Right. So if tariffs make imported goods more expensive, consumers might shift some of their spending to U.S.-made products and services. And since people always need a place to live, that could be good news for real estate companies that are, focused on the domestic market.
Okay, that's interesting. What other sectors are looking good right now?
Well, energy and renewables are definitely worth considering, especially with, the potential for disruptions to oil imports from Canada. This could create some real opportunities for alternative energy sources and for companies that are focused on U.S.-based energy production. Yeah, that makes sense. If oil imports get hit with tariffs that could drive up prices, and suddenly things like solar and wind power, they become a lot more competitive. Are there any specific companies or subsectors within energy and renewables that you're keeping an eye on?
Well, definitely keep an eye on companies that specialize in, solar panel manufacturing or companies that are involved in building those large-scale wind farms. These are areas where we could see significant growth if the cost of, traditional energy starts to rise.
Interesting. Okay, so we've got domestic-focused companies, utilities, real estate, energy, and renewables as potential winners here. What about tech? It seems like tech companies are always adapting to new challenges.
You're right about that. And that adaptability, that's one of their biggest strengths,
Yeah.
especially the companies that are really leveraging AI. They tend to be nimble enough to adjust to supply chain problems a lot faster than more traditional industries. And they're also less reliant on physical goods that are, subject to tariffs.
Right. They're more flexible. They're not as exposed to those price increases that could be driven by tariffs.
So within tech, are there any particular areas that you're, kind of excited about right now?
Yeah, I'd say keep an eye on companies that are, involved in cloud computing, cybersecurity, software development. These are all areas that are seeing strong growth, and they're less likely to be directly impacted by these tariffs.
Okay, this is really helpful. So we've got a framework for thinking about the potential winners. Now let's talk about the other side of the coin. Which industries should investors be approaching with caution or maybe even avoiding altogether?
Well, at the top of the list, I would say are export-heavy industries. Any company that relies heavily on selling their products to, Canada, Mexico, or China, they're likely to face some headwinds because those tariffs are going to increase their cost and make them less competitive in those markets. Right. If a U.S. company's products suddenly become 25% more expensive in Mexico, Mexican customers might start looking for other options. But wouldn't some companies try to absorb those costs at least partially to stay competitive? How can investors tell which ones are going to be able to do that and which ones aren't?
That's a great question, and it really highlights why it's so important to look beyond just the headlines, You have to dig into the financials of individual companies and really understand their exposure to these tariffs, their pricing power, their ability to adapt.
Okay, so it's all about doing your homework and really understanding the nuances of each company's situation.
Got it. So what other sectors are, kind of flashing warning signs right now?
I'd say manufacturing and automotive are definitely industries to watch carefully. They're both very reliant on these complex cross-border supply chains, and any disruptions caused by tariffs can really throw a wrench in their operations. Yeah, I mean, all those parts and components coming from different countries potentially getting hit with tariffs at multiple points in the process. It's like a logistical nightmare. And it could lead to delays, higher costs, and ultimately lower profits.
Exactly. And finally, we need to talk about retail. If these tariffs lead to higher prices across the board, retailers, especially those selling non-essential goods, they could see demand soften as people start to, tighten their belts a little bit.
Right. It's like that saying, when the economy sneezes, retail catches a cold. And this tariff situation, it sounds like it could be more than just a sneeze. So we've got our list of potential winners and losers. But I know you're also a big advocate for diversification. So how does that fit into all of this? It's kind of like we're building a bunker, making sure our finances are solid no matter what happens.
Yeah, a good way to think about it. Diversification. That's key in times like these. A well-diversified portfolio. It helps you ride out those economic storms and be ready to jump on opportunities when they pop up in different sectors. It's all about balance, having that resilience.
So instead of putting all our eggs in one basket, we're spreading them out across different sectors, asset classes, maybe even different countries.
Exactly. It's about managing risk and giving yourself the best chance to maximize your returns.
So it's not enough to just, pick a few stocks and hope for the best.
Right.
Got to be more strategic about it.
Right. Think of it this way. You wouldn't build a house using only one type of material, right? You'd use a variety of materials to make sure it's strong and stable and can withstand, whatever the elements throw at it.
Right. Different materials for different purposes. That's
Yeah.
a great analogy. So let's do a quick recap for our listeners. We started off by talking about how tariffs work.
Yeah.
How they can impact company profits and prices for consumers. And we talked about the role of the U.S. dollar as a safe haven asset.
Right. We also talked about the importance of staying calm and thinking strategically. It's easy to get caught up in the headlines and make those knee-jerk reactions, but it's way more important to take a long-term approach and really try to understand the underlying trends.
And then we dug into those potential winners and losers, in this whole tariff battle. We highlighted sectors like domestic-focused industries, utilities, real estate energy, and renewables tech as areas that could actually benefit from these changes.
Right. And on the other side, we talked about being cautious with those export-dependent sectors, manufacturing, retail.
Yeah. And of course, we talked about the importance of diversification as a way to navigate this whole shifting landscape. Building that resilient portfolio that can handle whatever gets thrown at it.
Absolutely. It's all about having a mix of asset classes, sectors, and geographies.
That's a lot to think about, but hopefully this deep dive has given you some food for thought. Before we go, I'm curious, what do you think is the most important question our listeners should be asking themselves as they process all of this?
That's a good question. I think the most important question to ponder is how these tariffs might reshape the global economy in the long run. Beyond the immediate impacts on individual companies and sectors, what broader trends might they accelerate? How will global supply chains change? How will consumer behavior change? What about the balance of economic power? How will all of that shift in the years to come?
Yeah, those are some really big questions. It's not just about picking stocks or timing the market. It's about understanding the bigger picture and trying to anticipate the forces that are going to shape the world 5, 10, 20 years down the road.
Exactly. And having that broader perspective, that's going to be essential for making smart investment decisions in the years ahead.
Awesome stuff. Well, folks, there you have it. Change can be a little scary sometimes, but it also creates opportunities, especially for those who are informed and prepared. Hopefully, this deep dive has given you the knowledge and the tools to navigate these choppy waters with confidence. Until next time, keep learning, stay curious, and as always, dive deep.
Arieous Invest. Trading reimagined.